Hey everybody, Levi here. Thought I'd make a quick video and answer the question about how corporate taxes work here in Canada and also tie that in with the advantages of incorporating. I've made a couple videos on incorporation, the benefits of that. So I thought this would be a good continuation of that. And again, talk about corporate taxes and just answer this question because I know this is something I personally struggled with when I was trying to figure out if I should incorporate. And I hear that all the time from my clients and other people I meet when they're kind of weighing that out. So this video is just going to explore the main benefits, considerations, and possible challenges of incorporating a business in Canada. And again, being aimed at business owners like you guys, we're going to cover areas like liability protection, tax benefits, and operational impact. So if you're interested in this, be sure to stick around, and I hope you find it useful. One big kind of thing with incorporating an advantage of it is separate entity status. Incorporating a business makes it a separate legal entity, fully distinct from its owners, which means that personal assets are typically shielded from business debts, which offer a greater level of security in case of any financial challenges, bankruptcy, and whatnot. Which kind of ties into the next one, limited liability protection, which is one of the most appealing aspects of incorporation is that limited liability. If a business incurs debts or faces any legal issues like lawsuits, shareholders' personal assets are protected and they only risk their investment within the business. Now, this is a general rule. Again, talk to your lawyer a little bit more, but for the most part, that's a really big one and a big advantage for folks who work in industries where there is a lot of lawsuit risk. Another topic I kind of want to familiarize everyone with, and this is something I kind of struggled with, and I hear just people really don't understand, is the concept of integration. Integration or tax integration helps align the taxes on corporate income with individual tax rates, which one, reduce double taxation, but more so it ensures when income is passed from the corporation to shareholders, the tax burden remains the same and you avoid any unnecessary penalties no matter which option you choose. So for the most part, as a business owner, you will be almost completely indifferent by taking money as a salary versus a dividend. If you do take a salary, you get that corporate income tax deduction, but you pay a higher personal tax. If you take your money as a dividend, you pay corporate taxes, but you pay a lower dividend tax. So the idea is with integration is that you're indifferent depending on the province and the year and things like that. There might be a little bit of a spread, 0.1%, 1%, things like that, which is kind of your accountant's job to help you figure out which one you should do. But again, generally you're going to be indifferent or it's at least going to be really, really close. So kind of the tax advantage of incorporating doesn't really have to do with that because you're indifferent if you take all your money as a salary, but there are a lot of other tax advantages. And here, 1 second here, let me find my mouse. But there are a lot of other tax advantages. So let's get into those. The main benefit you'll get is that you can potentially do some income splitting. This will depend on the government, currently not as much, but a lot more deductions, a lot less scrutiny on your deductions, and number one, most importantly, the ability to reinvest profits at a lower corporate tax rate, which will lead to significant savings over time. If you leave money within your corporation, you're paying tax at that SPD rate, which is about 11% depending on your province. Instead of taking money out, probably paying close to 50% personal tax. So again, that's about 40% more money that you can invest over time, which will compound. So again, that's a big benefit, really similar to what you have in an RSP, except it's basically unlimited. Another thing, kind of how corporate taxes work, is that you have lower tax rates. Corporate income tax rates are typically much lower than personal tax rates, especially for small businesses. In Canada, small businesses will typically qualify for a reduced tax rate on active income, which is on like active business income, not passive investment income. Anyways, that will help the business grow faster by keeping more profits in-house. Typically, you get that rate if you're making under $500,000 in active business income, and that rate is around 11%. Again, it varies based on your province. Another interesting thing with corporate taxes is the lifetime capital gains exemption. Incorporation offers access to that LCGE on the sale of any shares. That's currently set at over $900,000, so this exemption can make a significant difference in tax savings when solidifying a qualified small business. there are kind of some conditions that you have to meet to be qualified. So again, you'll want to talk to your accountant about that, especially if you are getting ready to sell your business. But that's an interesting consideration with corporate taxes here in Canada, and obviously a massive advantage. Um, in regards to actual taxation, corporate income is classified into two main types. You're gonna have active business income and investment income. Active business income benefits from lower tax rates, whereas that investment income is generally taxed at a higher rate, which will impact how funds are managed within the corporation. Um, if it's not obvious, active business income is going to be income from your primary business activities. If you're a plumber, providing your plumbing services is going to be active business income. Interest from your savings account is passive income, and kind of deduce the rest from there. I mentioned this briefly, but there is a small business tax rate for CCPCs, or Canadian Controlled Private Corporations. CCPCs qualify for an extra favorable tax rate on their first $500,000 of active business income. Again, like I already mentioned, this tax relief is designed to help smaller businesses reinvest their profits and support growth. Investment income within a corporation is taxed again at a higher rate than active business income. And for corporations with significant investments, the passive income limit might actually impact your eligibility for that SPD tax rate. So again, you'll want to figure out how you invested and make sure that you don't lose that if that is important to you and if you're eligible for it. Another interesting thing with corporations here in Canada is how you can pay yourself. I talked about this briefly, but owners can receive income from a corporation through salary, dividends, or combination of both. Each option has distinct tax implications and advantages, which can be tailored based on your personal and business financial goals. If you do have a salary, you're paying CPP, which is a cost, but you would get that benefit in the future. So again, there's a lot of considerations into each. So you want to look at it a little bit more, considering your personal situation, your age, personal borrowing you might want to do for a mortgage, things like that. Wouldn't really be able to make this video if I didn't talk about the disadvantages of incorporation. While it obviously offers numerous benefits, there are definitely some drawbacks. One, increased admin costs, filing requirements, and compliance can add up much higher in regards to administrative expenses. You're usually looking at a couple grand a year, potentially more depending on the cost of your accountant. So that definitely is a consideration. Also, personal tax credit restrictions. Corporations miss out on some of the personal tax credits, which may reduce tax efficiency in certain cases. There are a couple also tax pitfalls, and really having a corporation requires a lot of strategic tax planning to avoid these. For example, inadequate tax planning, passive income limits, and misuse of corporate assets for personal purposes can lead to a lot of different unexpected tax consequences or penalties. All that to say, incorporating can provide a lot of advantages in terms of liability, protection, tax benefits, but it's easy, or rather it's important for you guys to understand the nuances, including different administrative costs, tax challenges, to make sure it aligns with all of your business goals. Hopefully this provides a really good overview, puts some key terms in perspective, and gets you ready for any future conversations you might have with your accountant or lawyer as you prepare for this next step in your business. If you found this useful, be sure to stick around, and we'll see you in the next one.